Well, hello everyone, LA here. This is the weekly report, February 7th. It is for the report for the 5th. Last week, big gains in the indexes as they bounce these things right back up. They jam it higher again. Year-to-date returns astounding 13% on the small caps, 7, 5, and 3 elsewhere. Gold has sold off on the new year, as has the bonds, which is quite interesting. Dollar up 1.2% last week. And so what does this say to you? Well, to me it says that the buyers are simply unwilling to stay away from the trough, right? The feeding trough. When rewarded over and over, that's what they do, right? They just keep coming back. And so when you get a market that goes up for a long period of time, as soon as you get a setback, the first time back at least, they're going to buy it. We expected that. We thought it might be able to produce a little bit more on the downside, but it didn't. They came storming back in every day last week. And we've got multiple sectors now with double-digit regains over the last 5 weeks. Biotech, builders, energy, communications, the small caps themselves. It's kind of that reverse fear trade where your fear of missing out drives all action. I want to take us back on memory lane here. This is what's happening on the long end of the market. And if we look at this and then we look at the next few slides, maybe there's something to be a little bit worried about. I think it's a little early for that, given what we've seen. But maybe this is just normal, right? Where you get a big sell-off in the bonds on the long end of the curve, the 20 plus. And that, of course, drives interest rates higher. At some point, that's an issue. We assume that the Fed's going to come in and buy that long end of the curve. The fact that we got another $2 trillion going to be pushed out by the Democrats pretty soon probably is driving a lot of this action, and maybe it's already priced in at this point. So going back memory lane, this is where we are today. So you just had this retrace, broke a swing point, retest, regen. Usually that means that this is going to stay grounded. So in other words, if I were to look at this curve and ask myself, what's going to happen next, most likely we should get some sort of a back in here type thing instead of just a continuation to the top side. That's what we should expect. So after that 4.5% sell down, skyrocket right back up, make a new nominal high, and we should expect it to come back in some. But let's think about what happened a year ago. Back then, we saw the same sort of a thing, right? We had a new high, come back, do a 3.5, is actually about 3.7% retrace, and then what did we do? We shot back up, made new highs. And then we did what should happen, right? We came back, did a retest, and regenerated back to higher highs. But after that, just 3-4 days later, the top was made, and then we saw the huge sell-off, a collapse, almost 16%. To the downside. And after that first leg down, which was here now, you got the bounce, and the bounce took us back up a decent percentage. It was fairly significant, and then once more another spill, top to bottom, 35.5% off the top. That's not normal, of course. We said that back then. Am I expecting that? No, I'm not. But it does pay. It does pay to pay attention to what's going on, and to be recognizing the risks that are always out there, and the fact that you may or may not have to change your plans depending on what the market tells us. Just like now, back then, we were concerned, right? And I've put in, I'm not going to go through all these, but I've put in all the highlights of the sorts of things we were thinking back on January 19th, February 9th, February 17th, the 28th, and so forth, as we moved through that cave-in that took place. And the point is that things could change quickly, that being cautious was the right thing to do. I know that always sounds like, maybe you're making excuses or something, that you're not bullish enough or whatever it is, right? But we stayed, if you go back here, we said, don't initiate new ones, stay with what you have, stay long. But as things, start to look wrong, you have to take action, and you have to take action against what you have and what you want to do, because as the picture changes, you got to change with the picture. You can't just stay, stubbornly bullish. And so even though it looks like the buyers will keep buying ad infinitum, and it looks that way again right now. We know that's not true. We ride along as we can, as safely as we can, but we recognize that things can change. And the mantra I always throw out there is it never really matters until it does. And even though I'm almost certain that what we're seeing right now is not the same as what we saw a year ago, it's not the sort of technical breakdown that's going to be a massive downside, I do suspect that what we are going to see is that this market is going to try to claw higher, but it's going to be a slog. It's not going to be some sort of race to the moon type thing that we've seen, the gallop that we see at times, right, where almost all stocks and all sectors just keep going higher. To me, the better trades are going to be buying the retraces. And that's typically the case. That's typically what you want to do if you're trading neoclassically. It's going to be the reversals on the retraces, buying the retraces themselves, not the breakouts that are probably going to provide the best exemplary returns over the next few weeks, maybe even months. If I were allocating the money, most of your money should be allocated safer things, like the DBA is an example of that, not so much to the high momentum things like biotechs or some of these fad stocks. Now, if you're day trading, it's a different story. I'm not talking about day trading here. I'm talking about, trading something for a few days, probably weeks. And those sorts of positions are not where you want to chase high momentum things right now. If we look at the current technical picture, right, most of these sectors that could drive it, what are they? The ones that have enough weighting? Well, the biotechs, the financials, the industrials, the communications, potentially technology, although this looks like it might be spent, consumer discretionary. These sectors together make up about 70% of the S&P weighting. If you take the technology out, you're still at like 58%. So, can we go higher? Yeah, we can. There's enough happening. These are all on the either breaking out or about to break out. And if they continue their trends, which is what you usually bet on, then you could see this market make new highs and drag higher as I was talking about. But I think what we're going to see, given what this looks like, is that even though we've made new price highs, we haven't made new trend highs. And my suspicion is that 2-3 weeks down the road, we're going to look back at this and we're going to see this at a lower high while this has made new highs. And if that's the case, what that means is that most likely we're going to see another trip to the downside, some sort of a retrace that's larger in terms of price. So switching subjects here, I talked a couple of weeks ago about site tools, adding some Watchlist. There is one now that's out there. It's multiple swing point breakouts. You can get to it. It's this Watchlist. You can click on this to go to it if you're logged in. But what I'm looking at here is what are those things that are breaking out. And although I've outlined this and it's out there now, I'm already thinking that maybe one of the things, this takes both potential and actual breakouts and list them. So for example, if I look at this SSSI, that says that this stock has either potentially has broken out or potentially will break out on three different swing points on the short-term time frame. And it's a bearish breakout, and on the intermediate term time frame there's one potential or actual breakout taking place. And so this is a way to give you a heads up on a bearish, and here's a bullish one. This one is two of them on the long term, one on the intermediate, one on the short term. So on a daily, a weekly, and a monthly chart, you've got 4 potential breakouts or actual breakouts taking place on this particular stock. And like everything else with the watch list, you can traverse it, you can examine each of them, clicking on them, and so forth. It's a convenient way to communicate this. And one of the things I'm thinking is that we might take and use a capital letter to designate an actual and a small letter to designate a potential. I think that would give us more information. The other thing here is, as with all watch lists, you can download this, and here's an example of a download, and you can go click on it and download this file yourself. And it shows you how you can manipulate this data, to make it easier to view that watch list. For example, here I've taken and broken out all the swing points on different time frames, just so that I could do a quick visual of which ones are breaking out, which one has the most swing points being broken or potentially broken, etc. And so this, again, one of the things I'm thinking is the watch list is a good way to communicate stuff like this. Retest regens might be the next one I do in this series of watch list. Switching back to the market bottom line here, last week we knew that we wanted to try and buy the retrace. Unless you jumped on it Monday morning, you probably didn't get it. Intermediate and long term, they're still solidly bullish. That's what we talked about last week, and that hasn't changed. And now the short term is bullish again as well. I still am staying cautiously long. Longer term, short term, I still want to buy this thing. And what I want to buy? Well, I want to buy the retrace. And so, if you think about the market has done this, down and now made a new high. I suspect we'll see this retest of this swing point high that just broken, and we'll see that here in a minute, come back to a retest and try to regenerate higher. And we want to take and buy that retest, right? That would give us the best probabilities on our money. So that's the idea. Trading plan last week up about 1.5%, a little bit less, almost 4% on the year now. We added one position, nothing big. The thing that really makes sense to try and grab is the same thing we talked about last week, and that these 3-to-1s are probably the way to get your leverage in the fast move to the upside if this market does it. So if we get a retrace, again, this is where I'd be focused on putting those shorter term trades into effect. Fundamentally, politically, I don't really see anything out here other than the $2 trillion, that looks like it's going to get jammed through by March, early March at the latest, as being the big driver. Politically, there's always stuff out there. Now's no different, but I don't see, it seems like noise. Fundamentally, market's quite happy. Most of the numbers that we see in earnings and so forth are indicating that the market's going to continue to try and drive higher. And, this $2 trillion, we've discounted a good bit of it, but I suspect it's not all discounted yet, and we'll continue to see that discounted. Earnings are about over. I don't think they're going to do anything. Economic calendar, unlikely to do anything major. Next week, prognostications last week better than expected. What I expect this week, here's that retest regen I'm talking about. And so if we look at this and say, okay, can it come back and where to? I think this is the place you want to focus. And so I'm assuming that it's going to come back into there and you're going to want to buy it. If it was worst case, it would actually break and not hold. And now I don't actually expect this, but I think that there's, maybe a 30% probability that this would happen. If it did, I would think coming back into this little area here is probably where it would get bought again. 38, 36 or so. The most likely case, of course, is the one in black here, and that is that you retest and you start to regenerate back to the top side. And that's what I'll be trying to trade. And that's where we are this week. Have a great one. Stay safe. I'll see you next time.